Buy-to-let mortgage lending in 2022. This is part one of a two-part series where we're going to look at 13 of your most asked questions on buy-to-let mortgages and buy-to-let finance. So grab a notepad and pen and stay tuned. My name's Ranjan Bhattacharya. If you're new to this channel, make sure you subscribe and hit the bell icon. We put out new videos each and every week, and you certainly want to subscribe, hit the bell icon, so you get notified each time we upload a new video. Now, this is part one of a two-part video. We're going to answer 13 of your most popularly asked questions on buy-to-let mortgage funding. So you can skip to a question of your choice. You can see all the questions that we're answering in the description down below and navigate your way through all that. I'm joined to help us through your 13 questions by none other than Akhil Mayer from Our Mortgage Broker.
Thanks, Ranjan, for having me. It's been a year.
It's been a long time, and but our videos have done quite well over YouTube.
Thank you. Yeah, no, it's done very, very well.
Must be your good looks. And if you want to see what we're talking about, I'll put a link to some of the previous videos that we've done with Akhil. And actually, they're worth watching afterwards because you'll see how what we've talked about has really stood the test of time.
I certainly agree.
So just a quick introduction then. Tell us a little bit about Our Mortgage Broker and what you guys are all about.
Perfect. Thank you, Ranjan. For those of you that don't know me, my name's Akhil. I am the founder of the company by the name of Our Mortgage Broker. We are an independent and directly authorized firm. We are an all-rounder real estate finance brokerage based in Berkshire, but we've got independent and advisors that can help with first-time buyer mortgages, buy-to-let mortgages, as well as bridging and development finance as well.
Absolutely fantastic. That sounds like those terms and conditions that you meant to say at super fast speeds that no one can understand them, but you slowed it down first, which was brilliant. Okay, so let's have a look at some. I mean, you guys have been asking a lot of questions, and we've collated, as I said, 13 of them. Now, what do you think? What sort of changes? Because there's a lot of change going on in the investment landscape and also the funding landscape. What are you seeing? Because you work with a lot of predominantly buy-to-let and property investors. What are you seeing in the change of their investment styles in terms of the properties that they're looking for funding for?
It's a great question. I think COVID's been a blessing and a great recap of what the intentions of seasoned investors are to do going forward. And what I mean by that is a lot of the investors have rethought about their strategy, in particular with their portfolios. So a lot of our clients are large residential portfolio investors, and they want to keep that going for the long term because they find that a great asset class as well as a great cash flow basis. A lot of the seasoned investors are now moving into commercial property, and in particular retail properties that have got the opportunity to buy.
Now, where are they getting these ideas from? I mean,
I knew that was going to come in. If you guessed it, hit the like button, subscribe, and all that good stuff.
Oh, great. You've done my job.
There you go.
So anyway, these guys are basically looking for portfolio diversification. And it's buy-to-let they're looking at with commercial property.
Correct. So they're looking to, redeploy their cash or their surplus income into commercial real estate because they see the added value of moving into that sector simply because of the relaxation in the permitted development rules, as well as asset class changes. And, you're probably the best person to answer those for sure.
Well, how are you seeing, I've always talked about when you've got a residential buy-to-let, it actually makes a lot of sense to first of all leverage on the residential portfolio first and use that money to put in high deposits or buy cash the commercial assets, because commercial loan interest rates are slightly higher than residential buy-to-let. So max out on that first. Are you finding people are doing that?
Yeah, it's part of the advice process that we go through. And I always say to our clients, the best form of refinancing is either your primary residence, because that's where you're going to get the prime rates. Then you've got the second layer is refinancing your buy-to-let portfolio. The third layer would be use your own cash in your pocket, but everyone's only got so far deep pockets to go. But the reason why I say look at refinancing your portfolio is just simply because interest rates are at rock bottom, even though we've had a couple of base rate changes. But in the specialist market, in the limited company space and the specialist lender space, those rates haven't changed. If not, they've actually come down over the last 9 to 10 months. in particular with the 2 and 5 year fixed rates, and perhaps we can talk about them shortly. But a lot of our clients are refinancing their residential portfolios in order, as you said, to go and buy commercial property in cash, which then gives them the leverage to negotiate better terms and better price as well.
Yes, I guess one of the advantages, of course, is with residential buy-to-let loans is that they're more similar to residential mortgages, whereas commercial property loans are more similar to commercial loans. Well, they are commercial loans. And I think the big difference is that residential buy-to-lets, like residential mortgages, tend to be 25, 30-year terms, and commercial loans are a lot shorter.
Yeah, I agree. And you hit the nail on the head there. To get a commercial loan accepted, there's a lot more hoops to go through. There's a lot more due diligence. There's a lot more underwriting. And most important thing is the cost of borrowing on a commercial loan basis is usually double the price of a residential or a buy-to-let mortgage. So it does make sense on a monetary basis to refinance and capital raise.
So, of course, we've had huge inflation pressures brought about all this COVID, quantitative easing, money printing, eat out to help out, and all this sort of nonsense that we've all had to pay for. And that's finally having the effect of pushing up interest rates because, of course, they've got to control inflation. They've put up interest rates a couple of times. Where do the lenders see this going? How have they reacted to it?
It's a great question, and it's understanding the macroeconomics in a worldwide perspective. You've got energy prices going up 50%. You've got house prices going up X amount every single year. We've had a double-digit growth in the last 12 months, which has been great for existing homeowners as well as landlords. You've then got a supply and demand issue, so you've got energy prices going up. So it's not the easiest job to be the chancellor at the moment. But how best to combat inflation? Simplest thing is increase interest rates. But the flip side is if you increase them too quickly and a huge spike in those, you could have a recession on your hands and have defaults.
Well, the problem is that the inflation is induced a lot by the government. Higher taxes, NIs going up, this, that, and the other. There's also these green taxes because they want to achieve carbon neutral and all this sort of nonsense. So a lot of the inflationary pressures are a little bit false. And they're punishing people by obviously raising these interest rates. But I think the key question is, how are the mortgage lenders adapting to this? Are they actually passing these on to their customers? Because in the old days, when interest rates were quite high, the bank margin that they charged was a lot lower than it is now. So, I mean, they were making profits when they were charging 1% over base. Now they're 3-4% over base. Are they passing all those increases on to consumers in terms of the products, or are they absorbing it a little bit in the margin because there's a huge amount of competition out there?
Yeah, I think it's a really, really good question. As you have quite rightly said, there is a huge competition out there. Everyone is competing to be at the bottom of the table in terms of price and at the top of the table for providing the best times of service and criteria and interest rates. I think it is a very, very complex market to be in with interest rates. With regards to passing it on, the high street banks have to increase the tracker rate mortgages in line with the Bank of England, just simply because they are tracker linked to the Bank of England. So those people that are on those tracker rate mortgages or variable rates, you should be conscious that your mortgage payments over the next couple of months
I think in the way of new 5-year fix. If I'm going out for a new 5-year fixed rate mortgage right now, are we seeing a dramatic change in the rates that are being offered as opposed to if I was looking for a 5-year fix, say 3-4 months ago?
There's two sides, I would say. The high street lenders are certainly increasing the rates by 5, 10, 15 basis points. But on the flip side, the specialist lenders in the buy-to-let market are actually reducing those rates. I remember when we had these conversations about 12 months ago in 2021, a 5-year fixed rate was typically about 3.5%. Well, they're actually sub 3% now, which is great for the landlord, and it's great for yield, and it's great for borrowing perspective. So there's two different sides to mortgage market at the moment. But what I would say is interest rates are super competitive. They're still very low. If you are on a variable rate or a tracker rate mortgage, now's the time to start consolidating those mortgages, looking for fixed rates, because I think we might see a small increase going forward in 2022.
There is a small increase in interest rates, but the other thing to bear in mind is that the interest rate coverage has not changed.
Correct.
So if you're buying a 5-year fixed rate mortgage in a limited company, the interest cover is at the pay rate.
Correct.
So, and the other thing that's happened is even if that pay rate goes up a little bit, in the last year, in most areas, rents have increased. And my perception is that rents have increased more than the interest rates have increased. Do you buy that, and do you see that?
I think the calculation is actually disadvantaged, and I think they've overstretched that calculation because they're stressing at 5.5%. Those interest rates were in the early 2000s. You know, since 2009, we've had interest rates basically at 1%, if not below. So they've actually factored in, and they're weathering a future storm at 5% interest rates. You know, we're well away from that. I don't think we're going to be there.
What product are you talking about? I'm talking about the, you know, when you do a limited company fixed rate mortgage for 5 years.
Yeah.
Then it's at the pay rate. They don't have a stress test rate.
So if you're borrowing on a 5-year basis, it's done at the pay rate.
Yeah.
And Ranjan, you're saying it's based on the interest rate and a 5-year period.
Yeah.
However, if you borrow on a 2-year fixed basis, the usual coverage is then 5.5. So it is advantageous to borrow on a 5-year basis because the calculation is much more positive, which allows for more of a greater loan.
I think this is why you need to consult a broker for your specific area, because if you're in higher value areas, then a 5-year fixed, you get the lender coverage is far higher in a limited company, and you can borrow far more loan to value, and it's definitely more advantageous.
Yes, I certainly agree with that.
We'll get back to the video in just a moment. What is the most exciting opportunity in property right now? And that is repurposing defunct commercial buildings to residential use. Now, most people don't really know where to start, what to look for, and how to exploit these opportunities. And that's why I've prepared 90 minutes of free training for you to get you started on this wonderful journey. You can register for this free training at property-workshop.com. Join me on that free training, and I'll leave you to enjoy the rest of the video. I guess the crystal ball question next is where are we going with interest rates in 2022, 2023? Now, I'm my views, but I'm interested to know, do you think we're headed, are they going to rocket up north or what?
I don't think so.
Why
don't I think so? I think because they've got economic pressures on various different macros. You've got supply and demand issues, you've got energy price issues, you've got furlough to contest with, and that's going to be coming through now in the end of first quarter of 2022.
Yeah, but why does that mean interest rates won't rise?
Because I certainly believe they won't rise because of the economic factors across the world. And you've still got lots of other issues going on at the moment. We've still got Brexit to tie up with the loose ends at the moment. And we've got Boris doing his shenanigans at the moment as well. So there's lots of things going on in the background at the moment. And as I said, you've got supply and demand, you've got the China, you've got the Russia. And it's not just about the finance market. It's about the worldwide crisis going on, in particular in China. You've got Russia and Ukraine at the moment. So there's many, many factors that every single central bank needs to consider before hiking up interest rates. But I think they're doing this just to show that they are trying to combat inflation. I still think inflation will be heading towards 7% by the summer. And I don't think these small 25 basis point increases are going to bring inflation not going to bring it downwards. I think they should combat supply and demand and energy prices.
I think what they're trying to do is they're trying to put a shock to the system and trying to show that they're doing something. Yeah. It's more about virtue signaling that they want to tackle inflation. Mm-hmm. I think the issue with raising interest rates too far is this. First of all, we're in a global economy, and all the major countries' banking systems, reserve central banks, tend to follow a pattern these days, and they go in sync. And they've all done the same thing. They've all printed tons of money. So the inflationary pressures are the same. And we're all relative to each other in terms of inflation being high. So yes, we're looking at inflation being 7%, but it's the same in all the other major countries as well. So relative to each other, it's not that bad. The other issue is the amount of government debt there is as a proportion to GDP. When interest rates used to be 15%, government borrowing was about 35% of GDP. Now we're at 100%. So if the higher the interest rate goes up, the higher the cost of servicing the national debt.
Which they can't afford to do,
They can't do it.
So they can't do it. Pull back.
So it's partly they can't afford to do it because of the government debt being so high, and it's also relative to everyone else, we're all in the same boat. Our relative inflation compared to the US and the other EU and all of that isn't that out of sync. It's not that they're at 1% inflation and we're at 7-8%. It's not like that. So for that reason, I think it's a little bit of a shock, but I'm not convinced we're going to see massive rises. I'd be very surprised if it goes too much over 1.
Yeah, I made a prediction in 2021 that interest rates will start rising at the back end of Q4 last year. And they happened in December, but I think we'll be at 1.5% by Christmas of 2022. I think we will be there.
Well, let's see. Well, let us know what you think. Interest rates, are they going sky high? Are they going to moderate? I mean, what do you think? Tell us what your crystal ball tells you in the comments below. Where are you finding investors are actually buying investment properties? Are they Isle of Wight, Isle of Dogs, Southend-on-Sea? Where are they going?
The beauty is that we come across deals across our table from all over the country. So whether it's England, Scotland, Wales, and left and right of that as well. I believe a lot of people are buying further up north, so north of the Midlands and further up, so northeast, northwest, and parts of below Scotland. And the reason for that is just trying to catch better yields than there are down here in the southeast. Now, we're big avid fans of investing in the southeast just simply because capital growth. If you look at the latest news around yields at the moment, London has seen a 4% increase, but anywhere else has seen double digit or close to double digit growth. Some people might argue that they're trying to play catch up with London. Who knows? But if you're trying to catch the greater yields or you're in the start of your journey as a property investor, you certainly want to be investing in those core areas that are getting you 5, 6, 7% interest yields. Especially if you are investing in a limited company and you're paying 2.5 or 3% interest rates, you want to at least make a profitable margin and look for 5% yields.
Well, I think the problem with chasing yields is it's not the full story, because your returns from property are a combination of capital growth and yields. Mm-hmm. So in some areas where you have low yields, you'll get a big chunk of capital growth. Yeah. And in areas where you'll get a ton of yield, you won't get the capital growth. Yeah. So it's about finding that mix where you get a happy medium of the two.
And I think the other benefit is if you start having a diverse portfolio, so you might put some cash into commercial property, put cash into some HMOs, single AST property. So then you get a blended yield. So I think if you're setting out, and I appreciate that everyone wants to make a quick buck, but you've got to do it strategically and work with the right power team. But if you are a seasoned investor and you want to diversify your portfolio, I think now's a good time to start looking at complex investment properties such as change of uses. And you talk about it a lot in your YouTube videos, so a short little plug there. But I think you've got to look at those opportunities out there, because commercial property is going through transitions, and you can look at it at any high street where you see possible. But and a lot of my clients are simply doing that, is looking for opportunity for diversifying, just to benefit from the capital growth and yield.
So we talked a little bit about permitted development and conversion of commercial properties into residential use. Once you have converted a commercial property into, say, 2 or 3 flats, mm-hmm. what are the typical options there for refinancing that building?
Right. So the key here is when you buy a property is to understand what the end property description looks like. Are you buying a unit to convert into single units? Are you going to create leasehold titles for the 2 apartments above and the commercial unit? And the key here is to understand the values of each individual unit against a block unit. Mm-hmm. Now, if you're looking to convert the flats above to flats, for example, and then flog them off, you need to create leasehold titles to get the best values. Now, if you want to get the best investment value, you need to create individual leasehold titles, which does mean then individual mortgages, but it does allow you then to sell each unit as and when you choose to do so. The other benefit of doing so is you get better interest rates. So you'll get a residential rate for the upper portion if they're on their own leasehold titles, and then you'll get an individual interest rate for commercial units. And the commercial interest rates are extremely competitive at the moment, and that is by ensuring that you have a right covenant in place, the strength of the lease, and location.
Is there a threshold though? I mean, I get that with, let's say you're doing a shop and 2 upper floors and it's 2 flats. Mm-hmm. But if you're doing something where, there's 8 or 9 flats in a commercial unit, then does it not start to get a bit difficult finding individual lenders for each unit? Because a lot of lenders don't want to be they don't want to have loans to more than a certain percentage of the of the flats in a building.
Yeah, you are certainly right. A lot of lenders don't like certain exposure, percentage exposure over the whole block. So that's where you'll need to use, an experienced brokerage that understands that type of market and that type of property that you're looking to refinance or purchase initially. Now, you are certainly correct. Some lenders don't like huge exposure. Typically, it's between 25% and 50% of the whole block. But on the other hand, we can provide a blanket loan. There are lenders out there that will provide one loan over the entire block. Some lenders will work with 2 or 3 lenders at the same time. So it's just understanding.
That's often preferable, isn't it? I mean, just a commercial loan on the whole lot and a lot easier to manage.
It is. You've only got one set of fees, one set of lender deals to deal with. And if you've got, as you said, 9 units above, that's quite a lot of admin work and fees on top of everything else. So it's all about where you are in your investment journey. What do you want out from it? And if you're looking to retain that property, potentially one blanket loan facility over the whole unit might be an idea. And you might still be able to get that even if you've got individual leasehold titles and get one blanket loan facility. But again, it's not one rule fits all out all the clients. There's lots of other tangible vehicles that go alongside that. So the advice is bespoke to the inquiry itself.
Now, I wanted to talk to you a little bit about where you see the lending market heading in 2022, particularly in terms of limited company mortgages as opposed to individual investor mortgages. Now, 5 years ago, limited company mortgages represented a very small proportion of the buy-to-let mortgage marketplace. Thanks to Section 24 and the tax changes, we've got some videos on that explain what that's all about. But that's meant that it's less advantageous to own properties in your own name. So more and more lenders have had to come up with limited company products, and they've come down in price. What percentage split are you seeing? Are you seeing, is it now a majority of your buy-to-let loans for new purchases are limited companies?
Yeah, so if we rewind back to 2016 when the PRA brought into this Section 24 rule, it was a new arena for most people. There was a very small percentage that didn't know about limited company and they never invested in limited company. However, the audience has certainly grown and favoured investing in a limited company capacity, as well as so buy-to-let lenders as well. Now, give or take, there's about 40 odd buy-to-let lenders in the market, of which at least half of them now have a product range in a limited company. And the reason why they've done that is just simply because of the trends and the demand for limited company buy-to-let products. So the growth is certainly increasing from the lender side because they're seeing the trends and the demands for those types of properties. With regards to interest rates, 5 years ago, those rates were quite steep and quite punchy, but those rates have been coming down because the cost of borrowing and the margins that lenders are making, especially in the specialist lender arena, are quite favorable, and there's a lot of profit in the margin at the moment. 2021 rates have been coming down, certainly in the 2 and 5 year fixed spaces, even in a limited company space. And the lenders have been able to afford to do so because of their borrowing, because they've got lines of credit from institutional hedge funds, private individuals, and the alike. So they can afford to lend out at more competitive bases than they did previously. And that goes to show, the confidence in the market, I would say, from the investor side as well as the lender side as well.
Okay, there's a lot more to come with Akhil about the buy-to-let mortgage and finance space in part 2 of this series, so join us then. Let us know what you think about any of the issues that we've raised in the comments below, and also if you've got any questions that you want us to cover on buy-to-let finance in future videos, let us know also in the comments below. Make sure you subscribe, hit the bell icon so you get notified of new videos. Akhil, thanks very much.
Thanks for having me on.
You'll be joining us in part 2 for plenty more. See you guys in the next video. So what happens if you don't agree with the surveyor? I mean, the valuation comes back and you're all excited. You think you're going to get 650, but the valuation comes back 600. What do you do then? What are your rights to appeal?
That won't work, and that won't work in sync.
So what's the difference between an HMO valuation and a regular valuation for something that's let out on a single AST? Are you finding people actually taking advice on that? High streets across the land are changing forever. Basically, there's an oversupply of retail premises. Shops are closing down, more are going to close down in the future. The government know this, and that's why they're introducing a light touch planning system which allows small developers to easily repurpose these buildings to residential use under a light touch planning regime called permitted development. Now, this is going to be the biggest revolution and the biggest change and the biggest opportunity for property investors that I've ever seen. And this This is all coming into effect on 1st of August. So you need to know what's happening and what properties to look for to take advantage of these opportunities so that you can get in there and take that first mover advantage. I've got a 90-minute free masterclass to get you ready for August the 1st. Make sure you join me, click the link below. Whether you're a beginner or expert, we'll get you started.